Hello, I'm Sam Meredith, and today we're taking a closer look at the UK in light of inflation data which has hit a record low. Joining me from the Economist Intelligence Unit is economist Danielle Haralambous. So Danielle, UK Consumer Price Index data was released this morning and shows inflation at minus 0.1%. According to the Office for National Statistics, not since the 1960s has UK inflation fallen below zero. But what has caused this fall, and how is this likely to impact upon the markets?
The overwhelming influences are from food and energy prices, which fell very sharply since the end of last year. Sterling strength against the euro is also playing its part, but also the timing of Easter has depressed prices a bit this year. This shouldn't really influence the markets much. It was widely expected that we might see slightly negative inflation at the beginning of this year. In other areas, services prices are rising. Core inflation is at 0.8%. And crucially, there's no signs of it feeding through to consumers' expectations of inflation so far. If consumers think prices will fall more drastically or for a long period of time, they delay spending decisions. And that's when we need to worry about deflation, and that's when the markets will react to it. But at the moment, that's just not happening.
Bank of England Governor Mark Carney had warned that inflation may turn negative, which has now become a reality compared to April last year. But he also cited there are reasons to be optimistic that inflation would increase over the coming months. Would you agree with this optimism, and which indicators will most likely be the key influences for UK inflation?
Yes, we share that optimism. It's a fair assessment because a lot of the factors currently weighing on inflation are temporary factors whose influence will fade with time. Specifically, we expect a gradual rebound in inflation from around the middle of this year as the impact of last year's food and energy price falls leave the annual comparison. At the same time, there are underlying domestic pressures which will be building at the same time that spare capacity in the economy is eroding.
Lastly for today, Bank of England members are due to meet tomorrow to vote on whether to change interest rates. But how are you forecasting interest rates to change in the short term, if at all?
We're expecting the first increase in interest rates to arrive during the first quarter of 2016 of around 25 basis points. But actually the risk towards that is weighted towards a further delay, mainly because the bank downgraded its growth forecast in the May inflation report and also thinks that productivity will be slower to recover than was previously expected. The bank will also have one eye on the Federal Reserve in the US and the trajectory of monetary tightening there. And again, for this, the risk is that there's also a slight delay in starting the tightening process after first quarter data in the US came in slightly weaker than expected.
Thank you, Danielle. Check back with Duke for more updates throughout the week. But for now, goodbye.